A cash-out refinance allows you to access the equity in your home while still making mortgage payments. This is a good option for those who want to use their home equity for things like home improvements, debt consolidation, or investing. Welcome everyone. In today's video, we're going to look at what is a cash-out refinance and how does it work. But before we proceed, if you're new to this channel, remember, go ahead and hit the bell icon to subscribe so you won't miss the informative videos we will upload in the future. Now get ready and make sure to stay tuned till the end as we dive right into the video. An explanation of cash-out refinancing. Through a cash-out refinance, a form of mortgage refinancing, you can withdraw the equity in your house. The new mortgage exceeds your being mortgage sum, and the excess you admit payment in cash. In the real estate assiduity, refinancing is a common approach used to replace an being mortgage with a new loan that constantly has better terms for the borrower. You might be suitable to lower your interest rate, talk the ongoing loan terms, include or count borrowers from the loan obligation, lower your yearly mortgage payments, and in the case of a cash-out refinance, access cash from the equity in your house by refinancing. A cash-out refinance, on the other hand, enables you to adopt further plutocrat than the original mortgage quested and collect the redundant cash. Your house must have enough equity to allow you to adopt further plutocrat than the balance of your mortgage in order to be good for a cash-out refinance. You also need to have a steady payment, a good credit score, and a respectable debt-to-income rate. Both a cash-out refinance and a normal refinance bear these restrictions because you are adopting further plutocrat in the ultimate. What's the process of a cash-out refinance? Lenders looking to foreclose on their mortgages can work with lenders to make this happen. The lender reviews the borrower's current credit history, loan balance, and financial history. The lender makes an offer based on an underwriting review. A new loan is offered to a borrower who has paid off their original loan and established a new monthly payment schedule. For money that exceeds the repayment of the mortgage, the money is distributed. In a typical refinance, the borrower will not receive any money. Instead, their monthly payments will be reduced. Although the borrower is free to use the money from the repayment as they wish, many do it to pay off expensive things like textbooks or other large debts, to support debt, or as an emergency fund. When refinancing, less equity in your home means the lender is taking on more risk. This can result in higher closing costs, fees, or interest than using a standard mortgage. Loans and Department of Veterans Affairs loans are available with better terms and lower fees and rates than non-VA loans. How much money is available with a cash-out refinance? Although it may vary by lender and loan type, lenders expect you to maintain at least 20% of the equity in your home. You may be eligible to use a VA loan to repay 100% of your home equity if the Department of Veterans Affairs approves your loan, for example. In general, you are allowed to borrow up to 80% of the value of your property, but it is wise to borrow only what you really need. You will need to deduct any outstanding debt from the amount you will receive if your original mortgage still has a balance. A good deal with lower fees and rates than non-VA loans. Here's an illustration. Find out what your home is worth. Let's say your home is worth $300,000. You still owe $100,000 on your loan. The market value of your home with less debt means more equity in it. In this example, the value of your home to you is $200,000. Determine the maximum loan you qualify for. This represents 80% of your overall home value. In this case, $300,000 multiplied by 0.80 is $240,000. Enter the outstanding loan balance. You will need to subtract your original $100,000 loan from the new $240,000 loan, which equals $140,000. Calculate the total. In a cash-out refinance, you get the difference between the new mortgage loan and the balance in your old one. In this case, it can be as high as $140,000. Your lender will ask for an appraisal to determine the current value of your home, because the amount of mortgage you can get depends on the equity in your home. Your home may be worth more than you paid if home prices have risen in your area, increasing the amount you can borrow. Cash-out refinancing requirements. To qualify for a loan, you must meet the lender's requirements. These can vary, so it's a good idea to shop around for the lowest interest rate. However, you will need to meet the following requirements. DTI or debt-to-income ratio. Your DTI is calculated by dividing all of your monthly payments, including your mortgage, by your gross monthly income. The typical DTI for cash is 40% to 50% or less. Credit rating. As usual, a higher credit score should lower your interest rate, but if your score is 620 or higher, you may qualify for a Cash Out Refinance. Equality in a home. In order to qualify for a Cash Out Refinance, your overall home should have at least 20% equity. In other words, you must pay at least 20% of the property's current assessed value. Seasoning requirement. Regardless of your equity, you must own your home for at least 6 months with a conventional loan to qualify for a refinance. If you inherit the property or acquire it through other legitimate means, the lender may foreclose. You must wait 210 days after the first payment or after the 6th month's payment on a VA loan before applying. Before refinancing an FHA loan, if you have a loan that is approved by the Federal Housing Administration, you must have lived in the home for at least 1 year. Pros and cons of a cash-out refinance. Smart investors who have tracked interest rates over time will often take the opportunity to refinance when lending rates approach new lows. There are many options for refinancing, but generally speaking, many will bring a number of other debt, which makes the time of refinancing a home loan very important as a decision to refinance. Consider your financial needs in addition to reviewing rates and fees to see if refinancing is the right option. The interest rate for this cashback option is usually lower than for unsecured debt, such as a credit card or personal loan. Unlike a credit card or personal loan, you run the risk of losing your home if you can't pay your mortgage, for example, or if the value of your home decreases and you find yourself in an underwater mortgage situation. Ask yourself honestly if the need for the money means that you will lose your home if you can't make future payments. Take steps to reduce your expenses if you need money to pay bills so that you don't get dragged into a never-ending debt collection process. A refund may be the smartest decision for you based on the various good tips provided by the Consumer Financial Protection Bureau. The borrower gets all the benefits they are looking for from a typical mortgage, including a lower rate and possibly other valuable changes, as well as cash back. Are you a candidate for reinvestment? For many people, reinvesting can be a good decision. Interest rates are rising. However, because your home is used as collateral in the mortgage, lenders take less risk and can lower the mortgage rate. So one of the cheapest ways to cover big expenses is to refinance. Here are the things that homeowners often use silver for. Number 1. Project to renovate the home. Number 2. Investment objectives. Number 3. Consolidating debt at a high interest rate. Number 4. A child's college studies. That's all for today's video. Feel free to share any helpful information we've missed in the comments below. Don't forget to like the video and hit the subscribe button so you don't miss any new videos from our channel. Thanks for watching and see you all soon.